Good evening, good day, good morning, everybody. My name is Julianne Peterson, and I am your host every Tuesday night for Zoom at 8, meeting here on a Tuesday night and making relationships. It's kind of like going to a conference, but you don't have to get on a plane. You just sit at your desk at 8 p.m. Eastern. Now, for me, it's 5 o'clock, so it's not so bad. We have industry experts come every 3 weeks out of the month, and then we network after the meeting. So we go on for about an hour and a half, and you can find all of our videos, all of our conversations on my YouTube channel, Julie Ann Peterson, A-N-N Peterson. A-N-N-E Peterson. So check those out because there's, I think, 200 of them. We've had so many great conversations. But listen, I'm here. Also with Old Capital. And if you're not familiar with Old Capital, we've been doing this for 38 years. We are specialists in multifamily, but we will do all the asset classes. And boy, oh boy, have things been changing over the last couple weeks. Interest rates are down. We thought maybe we were going to see interest rate change on the SOFR, which is your Fed funds. That's where Jerome Powell spends a lot of time and energy, but not yet. But the 10-year treasury is starting to come down, which is thinking in the future that maybe in the month of September 18th and 19th, I believe, is the next Fed fund meeting. And maybe historically, we haven't seen any decreases between those meetings, but maybe with the issues going on with our employment keeps going down and down, we're losing jobs, potentially we could see a change in rate. I don't have a crystal ball. Mine broke. It was from Walmart. So, just kind of get a feel for what you hear in the what's going on in the market. But if you are looking for a loan, I'm hoping to be your lender of choice. So, what I'm looking for is a T12, a rent roll, your offering memorandum, if there is one, and your underwriting. And you're going to package it up, give me all the information. I'm going to hold this for 5 to 7 years. I'm going to hold it 7 to 10 years. Give me the details, and you give me the details when you're ready to put in an LOI, not before. I want to make sure you're getting with an insurance broker, with your tax assessor, and a property manager. And if the returns are still there and it makes sense, that's when you'll send it over to me. Okay, let's get on with the show. I'm excited about tonight. Ted Lanzaro is here. He is a 33-year CPA in real estate. Everybody wants to know who can help them with their IRS taxes. And tonight, you are here with a live conversation with our industry expert. Ted, is a highly recognized and respected certified public accountant. He's a real estate investor and a real estate broker. He is founder of Landmark GPA Group, LLC, which is located in Shelton, Connecticut. It is a boutique CPA firm specializing in accounting and taxation for the real estate investors, syndicators, developers, and passive investors. This is your guy. Tonight, bring your conversation, bring your questions. He has helped thousands and thousands of real estate business owners, entrepreneurs, and investors all across the United States implementing cutting edge tax strategies to save them thousands of dollars annually on their taxes. Don't you want to know how to do that? He is also an author of the Tax Smart Landlord and the Tax Smart Landlord Toolkit as well, with over 100 articles on taxation in the for the real estate industry, specifically for investors, landlords, syndicators, and developers. And his new book called Year-Round Tax Planning for Real Estate Investors is due out this fall. So make sure you write that down. Year-Round Tax Planning for Real Estate Investors. That is why I asked Ted to come in the middle of, we're getting into the third and fourth quarter here. We're kind of in the first inning right now in multifamily. For those of you who are new to multifamily, we have gone through such a tough road the last couple of years. It is time. You don't wait till December 31st to get figuring out what the tax strategies are. The time is now. And we're also going to talk about who is the right person for you to be going in capital raising from. What are their requirements for them to have tax deductions, and how you can find a solution for those folks that they're not knowledgeable, they're uninformed, I should say, of some of these strategies. So I want you all to get to know Ted Lanzaro, who is here tonight to answer your questions and talk about how do we save on taxes. So Ted, welcome to Zoom at 8. How are you tonight?
I'm doing great. Thanks. Yeah, I'm happy to be here. I appreciate you inviting me to come on. This is always something I enjoy a lot. It's always fun. So I'm ready to have, to answer some questions and talk a little about what's going on, and we'll see
You
how it
know,
goes.
not all CPAs have a great personality, right? CPAs certainly sit behind the desk. It's hard to get them out and talking. So that's why I'm excited for you to be here. I saw you on the internet and I'm like, this guy is engaging. I want to know more about him, and I want my audience to know more about how we can save on these taxes. And really also, we're in a time right now where people have lost money, Ted. They have lost money on these syndications. And we talk about cost segregation and how we're excited about the cost segregation and how we're saving on our K1s and how that's really such a great thing. But if you lose money in a deal and you've taken those tax deductions, how does a real estate professional or non-real estate professional, how do they deal with this?
Yeah. Well, I mean, so just to start, you know, it's it sucks to lose money on a deal. Let's just put it that way, right? The interest rates and the rising operating costs and all everything that has happened in the last year and a half, 2 years has been very, very difficult. And there's a lot of people out there struggling, and so right now, if you are in a situation where, so if you can hold on to a property, right, then, hold on to it. I mean, it'll come back eventually, right? If you have to sell and you have to take a loss, the limited partners, they're probably in a kind of an interesting situation because their their loss overall, okay, is literally almost based on their cash on cash, I'll call it return, but it's actually lack of return, right? So if you have a situation where, let's say I put in $100,000 into a deal, right? And now I've taken $60,000 in depreciation, right? Okay. Losses over the course of a couple of years. I have $40,000 of capital left, right? Now the deal sells and I'm going to get $60,000 back. Okay, so I'm getting 60 cents on my dollar. Now this is a very simplistic, thought process, right? I'm not getting deep. So let's say you didn't get any distributions, just as an example. So you're getting your $60,000 back, right? Okay. Well, you're gonna end up with a net loss. Okay, after all is said and done, assuming that you did not take the losses. Let's say you're a passive investor, you couldn't take the losses. They're sitting in a carryover on your return, right? Your loss is your cash on cash loss. So you put in 100, you got back 60, you lost 40. You now get a $40,000 deductible loss, right? Now, so then you're like, well, is there recapture? No, there's nothing really to recapture. You end up getting a K1 that actually probably shows a loss on the sale, maybe a gain in the rental operations or whatever. But when it all nets out, right? When it passes through and hits your tax return, you put in 100, you got back 60, you lost 40, you're going to get a deduction. Now, if if I'm a limited partner and I used that loss, let's say I used that loss against other rental income in the year I got the K1. Well, now I have a completely different situation, right? Because I may have some recapture on at least the part that I took the loss on, right? So I'm getting $60,000 back. I have $40,000 worth of capital left. I actually probably end up in a scenario where, I may end up actually showing a small amount of recapture income, possibly, right? And then it's different across the board for everybody, right? Because everybody's situation is different. And I always start every tax presentation with the idea that everybody's situation is different, right? So that's why we do year-round tax planning for people, because it's so specific to somebody's individual situation. Because from a limited partner standpoint, I could have gotten none of the loss. I could have used all of the loss against maybe a prior, or against a real estate capital gain that year, or against other rental income, right? Against other K1 income that I got from another deal I was in, right? That's a different situation. Maybe I'm somewhere in the middle. Maybe I use some of it, right? Maybe I was eligible to take some of it, but not all of it, right? So it's so individualistic. Now, from a GP standpoint, right? The GPs took a ton of, like, if you're a GP in a deal, like the typical 70-30 multifamily kind of syndication deal, you got 30% of the depreciation, right? In year one, right? You got, if there was a huge depreciation from a cost seg study, you got a huge negative. You didn't put any money in. So you might be sitting with, I have investors sitting with a couple $100,000 of negative capital, right? Well, when that deal sells, they're going to have to recapture all of that income before they get a loss. So somewhere in the middle, there's a net, right? But you still got to get back to zero net capital somehow, right? So you've got a ton of recapture. Maybe not so you're probably not recapturing all of the losses you took because you're taking a loss on the sale of the property, but you're recapturing some of it, right? And that's really important. I was at a conference. This is before the interest rates turned, before operating costs got up. So somewhere, let's say, I think it was June 2022. And I was speaking at a conference, and I'm sitting in a room, there's 60, 70 operators in this room. And I said to them, I bet you there's $1 billion of recapture sitting in this room, right? All of you guys have deals. You're all GPs. You're all, taking huge losses. I bet you there's $1 billion worth of recapture in this room. And everybody kind of chuckled. And I said, listen, there will come a time, right, somewhere down the road. And this is why when we say, and again, it's going to sound like a plug, but when I say year-round tax planning, we're talking about laying out for our people we do personal returns for. We're laying out, 3, 4, 5 year plans for these people, right? And the reason we're doing that is because at some point, you're either going to sell the property, you're going to either sell the property for a profit, or you're going to sell the property. Even if you have a loss, you maybe have gigantic recapture, right? You may not be able to get into another deal because the old model was, I sell a deal, I buy a new deal. I take 100, I'm in an atmosphere of 100% bonus depreciation, right? An environment of 100% bonus depreciation. I could sell a deal, buy another deal. I didn't even have to do a 1031 exchange. My depreciation probably on the new deal probably wiped out the gain on the old deal, right? That was the model up until about 2 years ago, right? And then as the bonus depreciation starts to sunset, right? And I believe we're at 60% now in 2024, and it'll go down to 40 and then go down to 20 unless Congress ever gets its act together and passes some legislation to renew that. But the way it stands right now, we're going to go 60, 40, 20, 0, right? And so you're not going to have the capability to wipe out recapture on sales. Whether you made money on the sale or you lost a little bit of money on the sale, if you took a big deduction up front, you probably have a taxable gain, right? So you may be in a situation where you can't wipe out the taxable gain on a property you sold with the kind of, I'll call it half-ass bonus depreciation you're going to get in in 2024 or 2025. So we're constantly looking at, I tell people all the time, I look at their returns and I say, just so you know, you have $4 million of bonus depreciation out there, right? Or $10 million or $8 million or whatever they have, right? I want them to know this because the year I come to them and say, you owe $2.2 million, right? And there isn't anything we can do about it, right? I wanted them to know that 3 years ago. I wanted them to know now that, it's possible that you're going to owe a whole bunch of money. If you bought, think about this, because most of the operators, we're working on, say, like a 5-year timeline, give or take, right? So if you bought a whole bunch of deals in 2021, your timeline is to be selling them hopefully in 2026 for a profit, right? If you do that, and the legislation, nothing changes, you're going to be in an environment where you have a whole bunch of gain and no way of offsetting it without doing a 1031. And okay, great. Let's see. I've got half a dozen, clients right now looking for, up like 1031 properties to buy, right? They're just not,
So let's talk about recapture, because I think nobody's talking about it. And I think it can be a real problem when you've got people investing in these deals thinking they're going to get a tax deduction as a limited partner. Can you break that down for us? Because I know every deal, everybody's tax situation is different. I get that. But when people are capital raising, trying to find money, and you're representing that this is going to get 60% of your cost segregation, your bonus depreciation, what does that mean for somebody who is a W-2 earner? What
yeah.
does that look like?
So if you're a straight up limited partner, right? And you don't, let's say you're a W-2, whatever, making five, six, $700 million a year, right? Okay. You're not in the real estate business, right?
Let's pull it down to maybe 80 to 100, maybe 200,000, because that's a reasonable amount of money for people to be in the room, right? Doing W-2s.
Okay. Yeah. Yeah. Well, look, I mean, you've got accredited investor criteria and whatever. But okay,
Sure.
so let's call it 300 just as an
Yeah.
example. Right?
Let's do
So
that.
you're at you're talking to somebody who wants to invest $50,000 in your deal. They make $300,000 a year. They have $1 million whatever net worth. They qualify as an accredited investor, right? Okay. If that person doesn't have any other real estate, okay, when they go to do their tax return, you can tell them anything you want, right? But the reality of it is they're not getting the tax deduction, right? They're getting a passive loss carryover. Okay.
Put
So
it
they
on the shelf.
put it on the shelf. That's exactly right. It sits on the shelf, okay, until one of a few various things happen, right? The deal sells. Now they can take the loss. They have other passive income from other sources, so they can use that to offset that. They eventually they get to year 4 or 5 of the deal, and it starts spitting out actual positive numbers on the K1s. Now they can use those numbers. They can use the carryovers to offset it, and ultimately, when the deal sells, they get to use the whole passive loss carryover, right? So for those people, I mean, this is not a tax play. This is hopefully this is a return on investment play. I'm investing in a deal. I believe in you, right? And I'm going to invest with you, and you are going to ultimately in 5 years provide me with, 13 to 15% cash on cash return on my money, right?
I
Okay.
love that, Ted. I think you really hit it on the head, because a lot of us who are out there capital raising are talking about the tax benefits of syndications. But I really love what you said. It's more of a cash on cash return on your investment. Don't necessarily talk about it as a tax benefit. Is that what I'm hearing you say?
Well, you can talk about so in the days when there were distributions, right?
Yeah.
For those days. But seriously, so if you're still getting distributions, awesome. That's amazing.
Right.
And so the idea was you're going to get distributions, but your K1 is going to have a negative number. So you're essentially don't have to pay tax on that money in that year, right? Okay. So you put in 100, you got your $8,000, back every year, right? Your K1 had a negative number, so you had this cash flow that you could use, right? But you didn't have to. It didn't go on your tax return as taxable income. Okay, so that's a real benefit, right? So that was the benefit if you're a passive investor, right? Is tax-free cash flow, right? Now, but here's the thing, right? Um, here's the thing. For if you're really looking, if you understand tax law, right? Then you can use that understanding of tax law to go after people who have certain situations that are more tax advantageous for them to invest in your deal. Okay. I'll give you an example. Um, I have clients that come to me and say, Ted, I've got a ton of net rental income. Why? Because they've got the same buildings they've owned for 25 years, right? There is no depreciation left, right? The mortgage is paid off. They may have $200,000 worth of net rental income every year on top of whatever they're doing, right? Okay. Well, those people, if you find those people, right, in your marketing, then you can go to them and say, look, you invest in my deal, you're going to get, you put in 100 grand, you're going to get a $60,000, negative K1 in year one. That $60,000 loss goes directly against their net rental income, right? So if they've got $200,000 worth of net rental income, they wipe it down to 140, right? And the trick is to, and the real benefit is if that 200, let's say that $200,000 of net rental income is sitting on top of a $300,000 K1. Well, that person's in a really high tax bracket. They're making $500,000. They have $500,000 worth of taxable income a year, right? So if you pull that from 500 down to 440 by giving them a $60,000 tax break, you're taking money out in probably like the 35% tax bracket, right? And if they live in California, it might be 40.
Yeah.
Right? And California doesn't really allow bonus depreciation, so you have to look at the nature of the loss. But the thought process is, you always want to try to give people a chance to deduct at the highest possible tax bracket level. So that's a really good strategy. Where do you find those people?
Yeah.
Who are the biggest landlords in your city? Right?
Yeah.
If I were looking for people with a lot of taxable income, I'd look at the people in my area who own buildings, right? And the older, the better, right? And that information you can pull right off of any of the,
Co-star.
CoStar, right? The other one is people who've sold properties, and it doesn't have to be a syndication. It could be, now so I have people that come to me and say, hey, Ted, so and so operator is selling this year. I'm going to have a big gain. Reinvest. Go. So if you can find people who are coming out of other deals, right? And what's really great about people who are coming out of real other deals is they're already used to. You're not re-explaining the wheel to them. They're already used to investing in deals, right? Same thing with people who people who own buildings, right? If I just sold, so a client comes to me and says, look, I'm selling I'm selling a property I've owned for 20 years. I'm going to have $1 million gain. What do I do with it? Well, if you can get somebody to do a tenant in common deal with you as an operator to do tenant in common where you go side by side with them, that's one option. But let's say you miss that window, right? You can't find that deal within the 45 days you've got once you sell the property. Well, I can still put that money into a syndication and wipe out maybe not all of the gain, but a good portion of it. So people who have sold properties, right, are typically good targets for capital raisers. Where do I get that information? I would say every major city town has a business newspaper that posts real estate sales transactions.
Mm. MLS too. CoStar would have it.
I mean, I don't, MLS probably, CoStar would definitely have it. MLS maybe to some extent,
Could be single family.
I know we have in Lower Fairfield County, Connecticut, where I live, we have the Fairfield County Business Journal. You go in there every week. There's a list of every property that's sold, every commercial
Sure.
property sold in the last, sometimes it's only two or three, but you can pull lists, right?
Yeah.
So those are all like really good. Those are all really good thought process targets, right? Now, I mean, you still have to find out who these people are. You got to get to them, maybe connect with them on social media, see if you can, try to, contact them somehow or whatever. But it's the same thing that like I used to have a real estate brokerage team up until a couple of years ago. And that's the same thing they would do. That's what they would do all day.
Sure.
We would talk to real estate investors all day. Right. So,
So, a lot of the folks in the room, they are investors. They're also, we've got some syndicators here. If someone were to ask about the tax benefits in these different types of structures, whether it's a syndication, a JV deal, self-ownership, are there more advantages to one over the other? Syndication, JV deal, self-ownership.
well, look, I mean, I'm going to be a little biased to be perfectly honest with you,
Sure.
because um, as many syndications as I do, and I represent a lot of syndications, and I invest also in some. Okay, it all depends on what kind of person you are. I think like I'm A type enough that I like owning myself and doing JVs,
Sure.
right? And I think from a tax standpoint, you typically can get more out of your deal if you own 100% of it, or if you own, if you're a JV with 25% each or whatever, right? You know,
Okay.
now with this caveat, you you're paying for that, right? Because you're putting in, if you're buying your own properties or you're JVing with somebody, you're typically putting a lot of money in. In a
Sure.
syndication, there's a really great benefit for the GPs, which is, as a real estate professional, you can get a ton of bonus depreciation basically without putting any real money in, right?
Mhm.
Maybe you LP too, but you can get, a couple $100,000 worth of depreciation to offset your income without really, just by signing on the, being a
A
KP
guarantor.
example, yeah, you know, and signing on the loan, having some, non-recourse debt to use as basis, right?
Mhm.
So if you're active in the deal, if you've got basis, and um
When you say
qualify
basis,
as a real estate professional,
tell people what you mean by basis. If you have
basis
basis in it.
basis means I either put cash in, okay. So when an LP puts in $100,000, they have $100,000 of basis. Okay. If I sign as a GP on a loan, okay, then typically I'm going to have whatever percentage of that loan I've guaranteed. That would be, I don't have to put any money in. I would have basis in that piece of that non-recourse debt. Okay, qualified non-recourse debt. So you when you look at that scenario, and again, I'm being simplistic. Okay, so
Sure. Perfect.
so uh, but that means I can deduct up to that amount, because you can't take deductions in excess of basis. Okay,
Mhm.
so you have to have basis to take losses.
Okay.
Okay, so as an LP, if I go negative, I lose the ability to take those losses. As a GP, if I have a big negative, if I have a big negative depreciation loss, I can't take that loss unless I've got some basis. I either put money in or I've guaranteed debt.
Mm. That's a big piece that I don't think people talk about.
Well, I mean, most operators understand this concept, right? So most of the people I deal with, totally understand this concept, right?
Mhm.
But that's the thought process, and the rest of the time you're talking to people, and I mean, but it's the same thing. Like when we're doing planning for people, I'll tell them, hey, you've only got X amount of basis left, right? You know, now it's getting to the point where we're getting so a couple of years ago, the big problem was, hey Ted, you remember that hey Ted, you remember that building we bought a year ago? Well, we just got an offer $5 million more than we bought it for. We're going to sell it, blah blah blah, right? How do we mitigate the gains, right? Now it's, hey, we got to sell this building, right? We're not,
Yeah.
know how we're going to take anywhere from a 15 to 30% hit on the sale, right? you know what does that look like? What are our how do we what is this going to look like on my K1? What is this going to look like on our LP's K1s? Can you lay that out for us,
That
right?
is so helpful to understand that.
Well,
Again,
we can do it so that the people can go back, because if
yeah,
you have to sell a deal, right, and you've got to communicate with your investors. See, and again, I've been doing this for a long time, and I've been a real estate investor for just about that same amount of time. If you're an investor long enough, right, you're going to have a deal that goes, right?
yeah.
They're not all going to be grand slams, right? You're going to have some that blow up, right? So the key, and most smart investors, not the beginners, right? Not the person you were their first LP and venture, right? But people who are regular passive investors who get into a lot of different deals or whatever, most of them, they don't love it, but most of them understand there's some risk to it, right? Okay. So, and they understand that if you're an operator and they've invested in 5 deals with you and 4 of them are good and 1 of them are bad, you're a very good operator,
Mhm.
right? You know, if they invested in 5 deals and 5 deals went, you're not a very good operator, unfortunately, right? So, unfortunately, sometimes that happens, but the bulk of them, if you communicate with them and you're transparent with them, right? And that's what we try to help our operators do
Mm.
is, look, we're going to sell this property. We're going to take a small loss. This is what your K1 is going to look like. This is the amount of loss or whatever that you're going to have, right? It's coming, right? Here's how much money you're going to get in actual dollars, right?
Mm.
On we can help them put together and say, look, you know, yeah, we're going to sell for a loss. Yeah, you did lose a little money, but think about but here's you got X amount. You put in 100. You got X amount of distributions. You're getting X amount of final distribution. Here's where you ended up, right? And if maybe they got 10, 15, $20,000 worth of distributions, they put in their 100, they got 10, $15,000 worth of distributions. They're getting 65,000 back at the end. Their cash, they got back 85 of their 100. They took a $15,000 hit. Okay, hey,
Mhm.
that's not the end of the world. You could have done that in the stock market easily, right? You
Sure.
put 100 grand in the stock market, you could dissipate 15 grand in a week last week.
And you
Right?
don't get any deductions on that, right?
Yeah, no,
So
well, you
there's
could
the
would be able. Well, I mean, if you sold it, you would end up
sure,
eventually taking a capital loss. But I mean, so there's always risk, and smart investors know that. I guess that's the point.
sure. Like I had a couple questions here. Candace asks if a limited partner has filed previous tax returns with receiving K1s from a multifamily property, then in year 4, They want their money back from the deal, and the team returns their investment. What would the limited partner's tax ramifications be?
They're giving back the entire investment.
They want their money back that they put in.
Yeah, good luck. Well, look, if you do that, right, you are a very nice person.
Correct.
And you are, so I will tell you, you're beyond honest. Okay, so that would be a very nice thing to do. You are beyond honest. Um, I would, if you were my client, I would, I would ask you, what is the percentage of, now this, I'm going to give you an answer, but this assumes that you have done nothing bad. Okay, as the operator, right? Okay, so
Wait, hold on. Before you say that, let's say this is a bridge deal, right? And they're really tough right now, right? That has been with the interest rates, right? The bridge loans went up from, 0.5 point to 5.5, right? So it's not that they bought the wrong deal. It was the time of that they bought it, that they purchased it.
okay, so yeah, so in my mind, you didn't, as an operator, you didn't do anything wrong. Okay,
Correct.
right? Shit happens, right?
Correct.
Okay. So, and that's part of the investment risk, that interest rates may change, environments may change, rents might fall, blah, blah, blah. Right. Okay.
Correct.
So when I say you did something wrong, like you didn't watch over the property for a year and it went to hell, right? So
Sure.
like if I've got a litigation claim against you because you're just neglectful of the property, right? Okay, then, but if you have put it in a good faith to run a great property and
Yeah.
leap happened and now, so I would say I would ask my operator this question: do you think you'll ever get another dollar from this client, from this investor?
Mhm.
Yes or no, right? If
Mm,
it's yes, yeah, this is one of my biggest investors, they've already pledged to put money into a different deal, yeah, maybe I give them their money back.
that's a good point.
Okay, if if um if they're threatening to file a lawsuit, even if it's a nuisance kind of a lawsuit, I still got to defend it. It's going to cost me money. Maybe I consider that. Okay. But generally speaking, my answer would be no.
Can't have
Sorry.
your money back. Sorry.
Where am I getting the liquidity to give you your money back? Right?
Correct.
Where am I
So
getting the liquidity to give you your money back? And so my answer typically, my recommendation to my client would be, sorry, I'm sorry, we can't do that. We don't have
okay.
the ability to do that. We have plans potentially to sell the property in 2025. And, and yeah, I see somebody's note. Yeah, somebody could buy them out, right? Who's going to buy them out at full price,
No one is going to.
right?
Now,
If I would
what
buy them out, I'd want to do it at least a 40 or 50% discount. And that's based on where the
totally,
capital is.
totally.
Right?
So what are the ramifications for the person who, they just want out. They remove themselves. They've gotten the K-1s that they've gotten over the 3 years, right? So they get their money back
So let's say they get their money back. Let's say you pay them back
to get
and
them out of the deal.
get them out of the deal. Let's say they've taken a $50,000 loss. So they put in 100, they've taken $50,000 of losses. Their capital is at $50,000. You give them back their 100, they've got a $50,000. They have to recapture that $50,000 of loss they took.
Okay.
Right.
And they,
They got their exact money back. They have no cash on cash gain,
yeah,
but they have to recapture the $50,000 of loss they took. Now, if that $50,000 is sitting in a capital loss carryover right now, there's no tax effect, right? Because they're going to
okay.
pick up $50,000 worth of gain, and they're going to have a $50,000 carryover that balances
Cancels
out.
out.
Okay. Now, if they've taken the loss, let's say they had a whole bunch of, so in the opposite scenario is they used it against a previous capital gain or against net rental income. They've used the loss on their tax return. They have no carryover. They pay tax on $50,000.
Pay taxes. That's a big thing, you guys. This is what's happening now. A lot of deals are going sour, and they took these, deductions, right? And they're going south. They've lost their money. But the IRS says, wait. I need to recapture that. So people think, well, I lost my money. Yeah, you lost your money, but you may owe some money in taxes, correct, Ted?
Yes,
Yeah,
it's possible. Yeah.
it is possible. A lot of people aren't talking about that.
Yeah, and that's why, right? When somebody approaches me and says, "We're going to sell our property, what is it going to look like?" Right? That's why we will do an analysis for them. We can tell them, not to the penny, but we can tell them, pretty close what it's going to look like. And again, it comes down to, so we call it year-round tax planning. And I tell my clients,
Yes.
look, anytime you're going to buy a property, you're going to sell a property, you're going to renovate a property, okay? All right. I need to know about it before you do it. Okay. Why? Because there's certain things that I'm going to want you to do, certain steps and strategies that we're going to implement before you close, right? Before you close on a sale, right? And so just as an example, and your cost segregation guy is not going to love this, but I had a client who came to me and says, "We're buying a new property. It's our intention to sell it in 2 years. Should we do a cost segregation study?" And the answer to that question is no, right? Knowing the client, right? Because the client, it's a JV deal, right? There's 5 of them. I know all of them, right?
Ah,
I do 3 out of their 5 taxes, right? I know every one of them has a net operating loss that would choke a horse, right? Why would you do a cost segregation study, right? You don't
well, in
need the
that case, yes. But how about on these syndications? How do you give them information about that if they're going to sell it? Because you're talking about 70 people in the deal. You don't know how it's going to affect all those people. So how do you,
we can tell them what their K1 is going to look like.
okay. But
And
that,
then
that
they have to
K1,
take that to their individual.
that's
And
right.
then but we would help the person, put together the information for their letter to their investor to make sure it's tax accurate, right? Again, being transparent, being accurate, giving them the information to go to their CPA and get it figured out. And if and when you do that, they appreciate that, as opposed to, they get their K1 in April, it's got a big gain on it they weren't expecting, and they're like, what the hell happened?
Yeah.
Right?
Yeah. Hey, I got a question. What do you call real money? You make a comment. Real money. What is that? What is that? How much is real money?
I guess it differs for everybody. I don't remember what context I was using. I used that expression in. What do you remember?
Well, we were just talking about somebody who has, makes a lot of, or makes real money. So, and I was saying, 200-300, but what is real money? What would an
I mean, look,
accountant look at as?
We were
I
talking
think
about basis. And so you said, well, 100,000 is basis in equity. And so right before that, you were talking about, putting in real money. Real money is probably relative depending on how much money each individual has, right? I mean, to me,
no, but in
plenty's
that
real.
context, I should have, instead of saying, well, yeah, but in that context, I was actually talking about actual cash.
Oh
So
yeah,
when
it's
I said
actual.
when I said putting in real money, what I actually meant was they actually put money into the deal.
That's
Got
right.
it.
But then
That
I
makes
wasn't
sense.
quantifying what quantifies as real money.
What the
What I
number
was
was.
saying
Got it.
is there are GPs that will put money into a deal, and then there's some GPs that in whatever deal they're in, they don't put in any actual money, right? So but they still get the benefit of the depreciation losses because they guarantee the debt.
So there's a lot of co-GPs now that are, have brought money into a deal. They get a K1 for their co-GP position.
Yeah.
Do you need to tell the accountant that they didn't bring money in? Do you have to tell them they brought money in?
The
Did they?
K1s are typically marked GP or LP, and they're typically marked active also. So there's a difference. If you were to look at, so let's say, for example, I'm a co-GP and I'm an LP in the same deal. I'm going to get two K1s, and they're going to be marked differently. So on the LP one, it'll actually just say, it won't say LP, but it'll say LLC member, and the active box won't be checked. On the GP one, it might, I don't remember what the exact wording is, but it might say managing LLC member and active, something along those lines. I don't remember what the exact verbiage on the K1 is, but you can tell by looking at the K1s.
Now, a guarantor is different than a co-GP. Now, let's say I borrow a managing member of the borrowing entity who is a guarantor. Does their K1 get looked at differently than somebody who hasn't signed on that loan? Yes, because they're taking the loan against themselves, right?
Yeah. Specifically, typically they're getting allocated the non-recourse debt, or whatever their
Yes.
percentage of the non-recourse debt is, right? Okay. And typically they're a GP in the deal, right? Because they're getting that GP bite for being the KP.
But if you're an LP on a deal and you're filling out your personal financial statement, a lot of times it will ask, what is the debt associated? What's the
That associated to you is zero.
As a limited partner?
Yeah, you don't have any liability for the debt.
I think that is completely missed on personal financial statements.
Well, not only that, but think about this. And I don't want to be negative towards any other professionals in the industry. Okay. But there are firms out there, we all have dealt with them from time to time, who are basically LLC creation mills, right? They never saw a problem that setting up an LLC wouldn't solve, right? And so they've convinced people that you have to set up an entity to invest as a limited partner for asset protection purposes. Complete crock of poo.
Interesting.
I mean, you don't have, as a limited partner,
right,
you don't have any liability. Well, that's the whole idea of being a limited partner. Why do I need an LLC to protect that from my personal assets? Nobody can come after me, right? But you don't know, you give me a typical 100 partner 100 partner investor list from a typical syndication, and 40% of the 40% of the limited partners have single member LLCs, right?
So
Which
not necessary.
Not necessary. And by the way, it makes it harder for the operator, because on the K1s, you've got to put not only the single member LLC and the tax ID number of that single member LLC, but then you've got to get the person's name and social security number, right? And what happens is, typically a lot of operators just, when their investors are putting in money or whatever, they just give them access to whatever portal system they're using, right?
Yeah.
And they go in and they type in whatever freaking information they want, right? Yeah. And then they do a download of the information. They send it to me.
Yes.
I'm like, half the information's missing. Well, that's what they put in. Well,
so I I want to just challenge you a little bit on the LLC, just because you're looking at it from a completely financial and tax standpoint. But from a liability standpoint, if something were to happen at that multifamily property and your name's in there, you can still be sued, where the LLC would prevent you from being liable in a different facet, not from a financial standpoint, like a recourse loan, right?
If you're a GP on that property, I'll agree with you. If you're
Yes.
an LP, you can't get sued. You have no liability.
You're in the back of the bus.
Zero liability.
Even if your name is a part, right? Because when they put together all the documents, all the paperwork, your name's a piece of that deal as a partner, even though a silent partner. So you can't be named in a lawsuit in any way.
No, you're a limited partner. You're a passive investor. If you're a GP, set up the LLC. If you're an LP, doesn't make any difference. You're wasting money. And in California, it costs you $800, right?
Absolutely. Every year.
Right? For each one, right? So it's not, look, like I said, go talk to, one of these nice firms that'll be happy to set them up for you. I see no purpose to them, and I've been doing this for a long time. And I never tell anybody, oh, you shouldn't have done that. That was kind of an unnecessary move. But I don't think it's a necessary move. There's nothing to it. It doesn't give you any advantages. Now, if I was going to, so I'll make one caveat to that, right? Let's say I'm this nice couple, Rob and Lori.
Rob and Lori, yeah.
Rob and Lori. Say I'm Rob and Lori, right? And I'm going to invest in a bunch of LP deals, right? I might set up an LLC, right? Rob and Lori LLC, right? Why? It's a partnership, right? All my LPK1s are going to flow into that partnership, right? Now, I don't need the asset protection, but what I might do if I were Rob and Lori would be, I might park a whole bunch of, pseudo business expenses in that LLC, right? I might claim that I looked at some properties in Fiji when I was there, right? And, deduct a couple of meals and maybe a couple of days of the hotel room and, whatever, right? A little of the airfare, I might put half my cell phone in there, half my internet, so I would do a process, that, I've heard called conversion, right? I think if you, the first time I saw it was Tom Wainwright, CPA.
Tom.
He wrote a book and he talks about converting.
Bill Wright, yeah.
Bill Wright.
He talks about converting non-deductible things you're paying for anyway into deductible expenses, right? So it's a really great point because you start looking at like, what am I spending money on anyway? And how do I create a business purpose for those things? And if I'm on the internet looking at properties all the time, looking at car wash deals, for example, or whatever, then I should be able to take some of my internet money and some of my internet expense and deduct it, right? Now, here's the big advantage of that. If I were to put that on my personal return, I might set off an audit. On a partnership return, there's a 99.99998% chance it never gets looked at. You got a better chance of getting hit by lightning.
I got a question. Accredited investor. Lots of your properties that you own as a limited partner, you go to get accredited, and these deals, you don't have any liability against them, like you said. Like, I'm not tied to the real estate loan, right? I put 50, 100, 300, 400, whatever it was in it. Now the value has gone down based on what's happening in the market. How do you value that asset? Now you put the 400,000 in, and it's not valued at what you bought it for. How do you put that on your personal financial statement? You put in, let's say, $2 million into limited partnerships. You go to get accredited, and the accreditation company says, you don't have any liabilities against these. I've got K1s. I see that, but I can't accredit you. How do you get accredited with the values that you have put, the money you put into these and they've lost value? But you have no liability to show that.
So typically, okay, so I get asked to write accreditation letters all the time.
Yeah.
Right? I typically only do them for clients, right? And the reason I typically only do them for clients is because I have a feel. I know what their income is, obviously, and I have a feel for what their net worth is. Okay.
Yep.
I don't necessarily have them produce a personal financial statement. Okay. So the real answer to that question is I probably, if you really wanted to know exactly how it should be done, let's say, so I would call the operator. I would say, what's the property worth right now? Okay. Can you call a broker and get basically a broker's price opinion, right? So
Okay.
they come back, we paid 6 million for it. It's worth 5.5 now. Okay. We owe 4 on it, just as a stupid example, right?
Yeah.
We have $1.5 million worth of equity. I own 10%. The value of my investment is 10% of 1.5 million or whatever example I just gave you, right?
Mm-hmm.
So it's 150,000, right? Now, because now you've taken the debt into consideration, right?
Yes.
And you've used your best effort, okay, to provide the most accurate answer that you possibly could provide, right? Now, that's the the book answer. In reality, we probably would just freaking guess, right? Or just give it a number, right?
Okay.
With the idea that if we know the property has lost value, we're not going to give it a number higher than what we put in, right?
Yeah.
Okay. We're gonna ballpark it, right? And if I only put $100,000 in, right? Let's say I've got $2 million of $100,000 investments. I have
Sure.
$200,000. I have $2 million in limited partnerships, right? And I go through my deals and I'm like, okay, this one's good, this one's good, this one's all right, this one's good.
Sure.
And I start just putting numbers to those, right? If I'm somewhere in the ballpark between 1.8 and 2.2 million, right? I haven't if I'm within that 5 to 10% range on either side, I have not materially misstated my net worth. Okay.
Yeah.
That's my opinion.
Can I
Right?
add or ask a question kind of?
Yes.
So let's hypothetically say, to add on to that question, we bought the property and it's here in Texas, and the whole time is 3 to 5 years. And because of the market, a year and a half, the markets went down a little bit. So that property was worth 5 million. Now it's worth 4.7 million. But we know that property hold time is 3 to 5 years. We're not going to be selling that for another 2 or 3 years at the very least. And by that time, there's a really, really good chance, we all know, the property value is going to go back to our 5 million and then some. Can we still guesstimate, like, I get it, it's come down a little bit, but at the very least, I want to show that it's held its value, because we're not selling this for 3 years anyway. And in that case, our money isn't really, it's unrealized loss, right? It's not a realized loss, it's unrealized. So when we actually do sell that property, we'll be realizing a gain.
Yeah. No, I totally get what you're saying, right? And so technically, okay, if you were to provide a personal financial statement to a bank, you're going to put a date on it. This is my net worth as of December 31st, 2023, right?
Mm-hmm.
So it really should reflect whatever the market value was on December 31st, 2023, kind of the perfect way I, said, which is completely unrealistic, by the way. And, I mean, nobody would do it. So the thought process is you're going to ballpark it anyway, right? And as long as you're, in the right, in the reasonable range of reason right? You're not going back and saying it's worth 7, right? Okay. Then, then you're probably fine. You're using your best efforts to produce a a reasonable estimate. So yeah, I get what you're saying, but you also are projecting gains into a personal financial.
Future.
Yeah, if future gains into a personal financial, which you're probably not really supposed to do, right?
Mhm.
So with that being said, um, it's real estate, right? Everybody, everybody's playing the game a little bit, right? The key is not to be a pig about it, right?
Well,
And
and I will tell you from a lending standpoint, they are looking at every little piece of information that is shared. If you say you are an owner GP and you are not on the operating agreement, that is not truth. So make sure that you're putting the right information on your personal financial statement, because the agencies are looking everywhere for fault, for defaulting. So it's really critical, because of all the default, and maybe that they weren't looked at as tightly. There was a lot more trust. Now they don't trust anybody, right? So
that's
I,
why being pretty transparent and being within the realm of reason so that you
sure,
can kind of back up. Because if you owned, 1,000 shares of Nvidia stock, you'd be able to go look the price up at 12/31. You can't really do that with real estate.
correct.
There's no,
Yeah.
market, board where you can go and say, oh, this property is trading at, blank dollars this week.
So this is a very large question for you, and then we're going to wrap it up here. What is the biggest mistake real estate investors do from a tax perspective that they need to be cognizant of starting today?
Yeah, I think I think the biggest mistake is communication, right? With their CPA, with their advisory team, lawyer, CPA, banker, insurance, whatever. And so it comes down to what we were talking about before. My sort of year-round tax planning process that I teach my clients, which is I want you to communicate with me. You will get the best of me if you let me know before you buy, sell, or renovate a property, right? Because I'm going to be able to tell you a whole bunch. And what's interesting, and it applies less so to syndicators and more so to smaller operators, JVs, and people who own their own properties. But like I've renovated 200-300 properties, right? Different levels of renovation, but say 200 really, really, renovations, right? And another 100, soft, maybe some of them we cleaned up and we sold, some of them we might have done a little bit of work, but let's say 300 overall, buys and sells of, small properties over my 30-year investor group. I could walk through an apartment building and come within 10% of the repair budget, right? Just because I've been doing this for so long, right? That's the advantage. So when I say, call me if you're going to renovate something, it's because I'm going to see your scope of work. And I want to be able to look at your scope of work and tell you what's probably going to qualify for 5-year, what's probably going to qualify for 15-year, right? Oh, wait a second, look at what you're doing here. If you do this instead of that, it'll qualify as a 5-year asset, right? Because if you're doing, let's say you go and you do a cost seg on the original purchase, and then you go and we see this all the time. Then you go put another $1.5 million in renovations. You do another cost seg for that $1.5 million of renovation, sure. Right? And you can do cost seg planning, right? Like if you tell me what you're going to do, I'm be able to look at your scope of work and tell you, don't do this, do that, because you're going to get a better cost seg benefit on the renovation. And I certainly could do it on a much smaller properties, right? And so I do that with my 5-unit, 5 4s and 5s and 6s in Connecticut all the time.
So Ted, if somebody feels like your energy resonates with them, you know, because it's hard to find good CPAs that know about real estate, that know about syndications. That seems like the biggest challenge for a lot of these education programs. The people that get into them, they're trying to help their investors, they're trying to help themselves. If this is something that, you know, you brought up some really good ideas for them, how would they get a hold of you? What would be the best way to connect with you?
I did put it in the chat. My email is ted@landmarkcpagroup.com. My phone number is 203-906-0505. You can find all that information on my website, which is www.landmarkcpagroup.com. So with the syndicators, what we actually do, I just want to make, I do
Sure,
want to know
please.
what we do. If you call me and you say, hey, we're about to put together a syndication, I send you the investor list requirements, right? I send you the documents we're going to need when you as you're putting together your syndication. I help you, get the bookkeeping for the owner's account. If you're taking capital, we get that book kept. And once you have your investor list together, like we have people who've done syndications already this year, complete syndications. We already have their completed investor list that when we get our 2024 software, we will be inputting those investor lists in October and November. And the reason we do that is because then we can get our K1s out as fast as possible. That's the deal. We work with our people during the year to get through all the setup steps to be able to get your K1s out. I am located in Shelton, Connecticut. I see that question. My phone number is 203-906-0505. I work with clients all over the country.
That is excellent. I do have a couple questions here. All cost seg or other depreciation will get recaptured at 25% tax rate. So it will help, only help if you are in the 32% or higher tax bracket. Otherwise, are you paying higher taxes at recapture? Ooh, that's a good question.
Well, the recapture rate is capped at 25%. Based on your ordinary income rate. So if your ordinary income rate in that year is 15%, then you recapture at 15%.
Yeah.
But the whole idea of cost segregation is and we were talking about this before, about taking down high bracket dollars, right? So you always want to take down high bracket dollars because the idea is I want to take down the spread between, say, 30. So assuming I have a very high income person, I want to take that spread down at the top of the bracket. So I'm going to take down dollars at, say, 33%, right? I'm going to drop them from 800 to 600 or 800 to 500. And that they're going to save at 35%. Then when they go to recapture, they're going to recapture at 25%, right? So cost segregation, people talk about, well, it's the time value of money, right? Well, it is the time value of money. You want to save in year one and pay back in year 5 or 6 or whatever. But to the extent that you can get that arbitrage spread, the difference between the tax savings at 33% and the recapture at 25%, there's an additional 8% spread there as an example, right? That you want to take advantage of, and it works the opposite way also. If I don't tell people you should take your $100,000 worth of income down to zero with a cost segregation study. Why? Because I'm only saving money at 15%. Let's say I know that person's going to make like $400,000 next year, and they're going to recapture some of it, right? Well, now they are going to. So you could in theory save at 50% and recapture at 25 because the year you sell the property, your income is going to be high, right? So that's why when I talk about looking at things on a 3 to 5 year spectrum and not not only worrying about this year, I literally just talked a guy out of doing a cost seg study. I didn't talk about doing cost seg studies. I told him to take the cost seg studies and do them the following year. Okay.
Yeah. All right. Well, listen, I can tell you love what you do. And I think it's worth either having you come back and let's dig in some more because you have so much information that's so helpful. Or if there's somebody in the room that's interested in talking to Ted, get on the phone with him. Okay. LandmarkCPA.com. That's the
LandmarkGPAGroup.com.
oh, let's fix that. It's LandmarkCPAGroup.com.
Yeah.
Okay. Yeah, we put that in
And there's a work with Ted Lanzaro page there. You can go in, you can fill out all your specifics. It sends me an email, and then I send you a little link to set up an appointment. We have a free introductory call. We talk about your situation, how we can help.
strategies.
Yeah.
Go into these things with the knowledge. How is this going to affect me? How can I benefit from this? My gosh. Thank you, Ted. Wonderful night. Really wonderful to have you here.